Financial institutions are foraying into Bitcoin-backed lending as Bitcoin adoption gains steam among investment managers and fiat interest rates tighten.
Welcome back to the channel, everyone. Today, we're diving into one of the hottest topics in the cryptocurrency world right now, Bitcoin-backed lending. With financial institutions embracing Bitcoin as collateral and fiat interest rates climbing, Bitcoin-backed loans are gaining serious traction. But what exactly is Bitcoin-backed lending? And how is it reshaping both retail and institutional finance? In this video, we'll break it all down, from the basics to the impact on the broader market. If you're curious about how to unlock the value of your Bitcoin without selling it, this video is for you. Let's get started.
Bitcoin-backed lending platform Ledn told Cointelegraph. Ledn, L-E-D-N, is supposed to be lend. Years ago, there was, for some reason, I don't understand why people did it. You know, the word hodl is meant to be hold. It's literally someone, I'm not joking, someone misspelled it, and then someone put the words hold on for dear life as if that was supposed to be what hodl meant. So years ago, it's similar to when the New York Stock Exchange got into the crypto space and they created Bakkt, B-A-K-K-T. It's meant to be Bitcoin is backed by this, but they spelled it childish and almost like weird to kind of seem like cool and hip for the cryptocurrency space. So I think Ledn came from, I think it's from the Winklevoss twins when they were trying to create a lending platform. So Ledn is just a misspelling of lend because they kept on thinking that everyone just needed like words that didn't exist.
Let's start by defining what Bitcoin-backed lending actually means. In simple terms, it's the process of using Bitcoin as collateral to secure a loan, much like how you might use real estate or stocks. Platforms like Ledn, a key player in this space, facilitate such loans. If you're familiar with traditional lending models, you know that to borrow money, you typically need to put up collateral to secure the loan. Bitcoin works the same way. Instead of traditional assets like cash or property, Bitcoin serves as collateral, allowing borrowers to tap into the value of their digital assets without selling them. So why is this concept gaining traction right now? As Bitcoin adoption accelerates, especially among large investment managers, many are looking for ways to unlock liquidity without having to sell their Bitcoin holdings. Fiat interest rates are tightening, and the low-interest environment that we've experienced over the last decade is shifting. For investors who believe in Bitcoin's long-term potential but want to access its value in the short term, Bitcoin-backed lending is an attractive option. This allows them to hold on to their Bitcoin while accessing liquidity, benefiting from potential future price increases. Ledn is one such platform that facilitates Bitcoin-backed loans. Since the beginning of the year, Ledn processed over $116 billion in cryptocurrency loans, with much of this demand coming from institutional players. Lenders using these platforms typically earn upwards of 10% annual percentage yield, APY, on their money, a figure that's catching the attention of investors looking for higher returns in the current low-interest environment. But why is this important? The resurgence of Bitcoin-backed lending is reflective of a broader trend within the cryptocurrency industry. We're witnessing a shift where more traditional financial mechanisms are being applied to digital assets like Bitcoin, further blurring the lines between traditional finance and the decentralized world of cryptocurrencies. This evolution is fascinating as it mirrors what we saw in traditional markets decades ago, but now it's being applied to Bitcoin, a decentralized digital asset. If you're unfamiliar with the history of Bitcoin-backed lending, it's worth noting that this idea has been around for a while. However, its current resurgence is tied to a larger narrative. Bitcoin is evolving from being perceived as a speculative asset to a reliable store of value, and now even as a financial tool for generating passive income. The institutional involvement in Bitcoin-backed lending is a testament to this shift, and it signals a growing acceptance of Bitcoin as a financial instrument beyond its initial use case as a payment method. And speaking of payment methods, it's important to remember that Bitcoin's original purpose was to function as a decentralized currency, free from the control of central banks and financial institutions. Over time, Bitcoin's narrative has evolved from a payment network to a store of value often likened to digital gold. While it still serves as a payment network in some regions, especially with the rise of the Lightning Network, Its primary role today is more akin to a financial asset that investors hold for its long-term appreciation potential. But with this new role comes new challenges. Bitcoin-backed lending is one of those innovations that tests the boundaries of what Bitcoin can and should be used for. It also brings Bitcoin closer to the traditional financial system, something that some purists in the cryptocurrency space are wary of. The introduction of interest-bearing Bitcoin products like staking and lending raises questions about whether Bitcoin is being co-opted into the very system it was designed to disrupt. One of the more controversial voices in this debate is Michael Saylor, the CEO of MicroStrategy. Saylor has been an outspoken advocate for Bitcoin, but he made headlines recently when he suggested that Bitcoin, by itself, doesn't do anything.
MicroStrategy is really just providing a set of institutional instruments that institutional investors can use to tailor a portfolio that's long, short, hedged. They can sell the volatility, they can arbitrage the volatility, they can arbitrage any instrument against any other instrument, they can generate yield, they can buy insurance. Some of those people that are short, they'll short $1 billion of MicroStrategy and they'll buy $1 billion of Bitcoin. And so if we didn't exist, then billions and billions of dollars of capital from the traditional finance markets wouldn't be invested in Bitcoin because they can't buy or hold the underlying crypto asset. They can only buy securities or bonds or options or other instruments.
This comment sparked outrage in the Bitcoin community, as many viewed it as downplaying Bitcoin's potential. But in reality, Saylor's point was about Bitcoin's role as a store of value. Bitcoin isn't meant to generate yield or perform tasks like a traditional financial asset. It's a decentralized form of money that exists on a public ledger. Its value lies in its scarcity, its security, and its ability to serve as a hedge against inflation and currency devaluation. This brings us to an interesting point. As financial institutions increasingly adopt Bitcoin-backed lending, are we seeing the reintroduction of debt into a system that was designed to be debt-free? Bitcoin was created as an alternative to the fiat-based, debt-driven economy. It was supposed to provide individuals with a way to opt out of the traditional financial system and avoid the traps of inflation and endless credit cycles. By using Bitcoin as collateral for loans, are we not reintroducing the very elements that Bitcoin was meant to eliminate? It's a complicated question, and there are no easy answers. On one hand, Bitcoin-backed lending provides liquidity to Bitcoin holders, allowing them to access cash without having to sell their Bitcoin and potentially miss out on future price gains. On the other hand, it introduces the risk of debt into the equation. If the price of Bitcoin drops, borrowers could face margin calls and potentially lose their Bitcoin if they can't repay their loans. This is the same risk that exists in traditional lending markets, and it's something that Bitcoin borrowers need to be aware of. So where does this leave us? Bitcoin-backed lending is likely to become more popular as Bitcoin continues to gain mainstream acceptance. As more institutions get involved in the space, we can expect to see even more sophisticated financial products built around Bitcoin. However, it's important to remember that these products come with risks, and they represent a departure from Bitcoin's original vision of a decentralized, debt-free financial system. If you're considering participating in Bitcoin-backed lending, it's crucial to do your homework. Make sure you understand the risks involved, especially if you're borrowing against your Bitcoin. While Bitcoin-backed loans can offer liquidity and the potential for high returns, they also carry the risk of losing your Bitcoin if the market moves against you. This is especially true in a volatile asset class like Bitcoin, where prices can swing dramatically in a short period of time. In conclusion, Bitcoin-backed lending is part of a larger trend toward the financialization of Bitcoin. While it offers exciting new opportunities for both retail and institutional investors, it also brings Bitcoin closer to the traditional financial system that it was originally designed to disrupt. As with any new financial innovation, it's important to approach it with caution and fully understand the risk before diving in. If you found this video helpful, don't forget to like, subscribe, and check out the links in the description for more insights into the world of Bitcoin and cryptocurrency. We're just getting started in exploring the full potential of Bitcoin, and the developments happening now are only the beginning. Thanks for watching, and we'll see you in the next video.